Are you wondering how much you're going to have to pay in capital gains tax at the end of this upcoming year? If so, enjoy the next few minutes of this video where I break down short-term versus long-term capital gains and the difference between the two, the tax rate that you might be at your current income level, and then finally how much money you should set aside for the end of the year when you finally have to pay Uncle Sam his money. And don't forget to like and subscribe to the channel. It helps grow this tremendously. I bring you new content every single week. And let me make a disclaimer quick before I get into the content that I am not a CPA. I would highly encourage and recommend you to talk with one because the information I'm about to provide is for educational purposes only. There is no validity to the statements I'm about to make, and please verify all this information for yourself. So without further ado, let's jump into it. So first things first, what is the difference between a short-term and a long-term capital gain? And the simplicity of it is this. The investment that you make, if you hold that investment, whether it's real estate, stocks, bonds, cryptocurrency, whatever it might be, the differentiating factor is the amount of time you've held it. Anything held for longer than 12 months, 365 days, or 1 year is considered to be a long-term capital gain. Now, anything held for less than that, you can probably guess, is considered to be a short-term capital gain. Now, I know with information like that, you might still be confused, so let me jump into some examples for you. Let's say, for example, in our industry, in real estate investment space, we flip a house. We bought it in January, we sold it in May. That is going to be considered a short-term capital gain because we only held it for 5 months. Say we profited $30,000 and we are taxed at the short-term capital gain basis, which I will get into in just a little bit. Now we can look at it from the other standpoint of, say you bought Tesla stock back in 2015 and you sold it this year. It went to the moon. You made an incredible return on your investment, but you decided it's time to get out. Because you've held it for several years or you've had a rental property for several years, that is considered a long-term capital gain and will be taxed at a different basis than your short-term capital gain. So all in all, it's pretty simple stuff. But let's actually get into now what the tax rates are for short-term versus long-term capital gains so you can see for yourself how much you might owe at the end of the year. So what's the difference in tax rates? First, let's get into short-term capital gains tax rates, which is taxed the same as your current ordinary income. So if we look at the graph that's on your computer screen right now, you can see that there is multiple different categories. You have if you're single, if you're married filing jointly, if you're married filing separately, or if you're the head of a household. So for example purposes, let me just give you a makeshift scenario that we can refer back to for the remainder of this video. And let's say that you are currently married and you and your spouse make a combined total of $225,000. So if that is the case, if we are looking at the short-term capital gains rate, that would mean you would fall into 24% tax bracket, $178,000 to $340,000 because you are married filing jointly. So if you make $225,000 per year as a combined total with you and your spouse, that means you'll pay 24% of that income in tax, which let's jump onto my iPad and see what that actually looks like for you. So you would be in the 24% tax bracket, and if you make $225,000 a year in income, you would pay about $54,000 in taxes. And I am assuming that you're not deducting anything. It is just a very basic standard rate, which again, like I referred to in the beginning of this video, talk with your CPA for a more in-depth look. I am giving a broad overview in this specific video. And now let's go into a flipping house example of what you might actually pay on the profits you make from flipping your first property. So let's say that the grand total for profit on your house flip is about $30,000 and it took you 4 months to do. So as we discussed before, you will pay 24% of that in taxes, which means you would pay $7,200 of the total $30,000 profit in taxes. Now you might have other deductions on the property that you can write off, or you might decide to hold it for longer if it's a rental property or you're doing a refinance. But again, figure out what strategy works best for you and stick with it. So if you pay that $7,200 in additional tax on a $30,000 profit, that means from your $225,000 a year income, it would be pushed up to about $255,000. You'd pay $54,000 in tax on the $225,000, and then you would pay $7,200 in additional tax, for a grand total of $61,200 in taxes for the year. Now again, this might not be applicable to your exact scenario, but I'm just giving you examples so it's better and easier to understand throughout the entire process. But let's jump into long-term capital gains on what you might see from the stocks or real estate that you've been holding for the last couple of years. Now let's give a hypothetical scenario. Let's say back in January 1st of 2015, you bought $20,000 worth of Tesla stock, which if you could have predicted the future, that would have been an amazing time to invest in Tesla before it skyrocketed, and you would have made an insane amount of money on your $20,000 investment. If you bought TSLA Tesla stock back in January of 2015 for $20,000 at what Tesla is currently trading at, it would now be worth $414,286 and some change, which means you made about $394,000 in gain. Now, long-term capital gains tax rates are different than your short-term capital gains, and in fact, they are significantly lower in most cases. So what does this mean on that huge gain you made from Tesla over the last 7 years of investing in the space? Well, the long-term capital gains tax bracket is much different, and there's only 3 different thresholds of tax brackets that you might fall into. One being 0%, the other being 15%, and the last being 20% as of 2021. So let's refer back to our first example of the married couple filing jointly, just so we can use that when we look at this actual table. If you made a long-term capital gain between 0 to 80,000, that means you would pay 0% in taxes. 80 to 501,000, you would pay about 15% in taxes, and a greater than $501,000, you would pay 20% of that money in long-term capital gains tax. So on this Tesla stock, you made roughly $394,000. So that would fall into the 15% tax bracket. So you would owe 15% of that $394,000 in taxes, which means you would owe roughly $59,142 in tax on that specific money. And now you might be thinking, Carter, what about my other income tax that I owe on my short-term capital gains plus my ordinary income? Well, you have to realize that your long-term capital gains doesn't go towards your ordinary income, meaning that it would push you into a higher tax bracket, which is an amazing thing, because if that was the case, you would be paying significantly more on your ordinary income and short-term capital gains basis. But with the way the United States has structured their tax code, it is advantageous to invest for the long term because you will pay less in tax, and hopefully, if you invest properly, your investments will be worth significantly more in the future than they are right now. Now, in all these examples I gave you today, we were not assuming any sort of deductions, depreciation of real estate, or anything of that matter. I'm giving you rough examples so you have an idea for yourself on how much you might owe at the end of this year. And again, consult with your CPA to figure out your exact numbers, because there may be additional tax that you will owe on top of what I just discussed today. And again, this was just to give you the broad basis of short-term versus long-term capital gains and how that might affect you in months or years to come. And now, if you're interested in learning how we earn infinite returns on our money in the real estate space and how we are able to depreciate our properties and show very little income and pay very little tax, watch my video right here on how we bought this rental property actually getting paid from the bank.